Most of us are focused on domestic inflation, the housing crisis, and why wages seem to have hit a ceiling. But while domestic policy dominates the conversation, a $10 trillion financial shift is occurring beneath the surface of the global economy. This reallocation of capital is pulling investment out of traditional manufacturing hubs and redirecting it across unproven trade corridors. It is a transition that determines what you will pay for groceries tomorrow. To understand why this is happening, we have to look at the system that dominated the last 40 years. We built a world where a semiconductor designed in California was fabricated in Taiwan, assembled in China, and shipped to a shelf in Ohio exactly when it was needed. This hyper-optimization suppressed global inflation for decades. It flooded the United States with cheap goods, which allowed the American middle class to maintain its standard of living despite stagnant wage growth. That system was mathematically fragile. A pandemic, regional wars, and rising trade tariffs did more than stress the logistical network. They broke the foundational logic of global trade. The mandate for global corporations moved away from maximum efficiency and toward supply chain resilience. Replacing a 40-year-old network is triggering a massive industrial pivot. Rebuilding the physical infrastructure of trade requires trillions in new investment. The period of cheap, frictionless trade has ended, leaving a vacuum that is currently redefining the cost of living in the West. Billions in foreign direct investment are fleeing old industrial hubs, moving toward nations that share our borders. In a significant shift, Mexico has overtaken China as the top trading partner of the United States. Industrial parks in Monterrey and Tijuana are operating at maximum capacity, absorbing new manufacturing contracts for automotive parts and medical devices. But moving production into a developing infrastructure grid requires massive capital expenditure. Corporations are facing severe labor shortages, power grid limitations, and higher baseline wages than they found in the old Asian hubs. This structural volatility creates a resilience tax. When supply chains move to safer, politically aligned countries, the baseline cost of production rises. While politicians often focus on the security of these new supply lines, the transition costs are passed directly to the consumer. Beyond Mexico, a secondary economic bloc known as Altasia is attempting to replicate the manufacturing dominance of China. Stretching from India to Vietnam, it offers a massive alternative for electronics and textiles. But Altasia is a patchwork of 14 different nations with fragmented digital governance and underdeveloped ports. Forcing a unified logistics network across these disparate, unaligned regulatory environments creates immense friction, delays, and staggering added costs for corporations. As billions are poured into Vietnamese ports and Indian factories, the data reveals a secondary story about who actually owns these new facilities. Many new factories are actually funded by Chinese capital. To bypass tariffs, Chinese firms offshore production to Mexico or Southeast Asia for final assembly. We haven't eliminated our dependency. We've just added an expensive middleman. The American consumer is paying higher prices for a relocation that does not solve the original geopolitical risk. Rebuilding global trade routes requires staggering amounts of capital. Trillions of dollars that could have been spent on research, development, or domestic wage increases are being used to pour concrete in foreign industrial parks. This capital expenditure shock drains corporate balance sheets. To maintain profit margins, companies must either raise consumer prices or find a way to lower the cost of labor. The escape hatch for these rising costs is automation. Trillions are flowing into cloud-based data platforms, predictive machine learning, and advanced robotics. If a factory in Mexico costs more to run than a factory in Shenzhen, corporations balance the ledger by removing human workers from the equation. The supply chain is moving closer to home, but the jobs are being automated away to offset the cost of the move. The previous era of globalization exported American jobs but imported cheap goods. This kept life affordable even as domestic wages remained flat. The current shift keeps goods expensive while automating the remaining jobs to pay for regional resilience. As the world moves from global efficiency toward regional security, the baseline cost of household goods has reset at a higher floor. The inflation felt in the current economy represents a permanent geopolitical premium. National security and economic efficiency are at war, and the American consumer is paying the price for the transition.